on Silicon Valley Bank, fractional reserve system. And some of you have seen my tweets, which is awesome. I'm really fortunate because I was able to get Tony Denaro, one of my favorite people, to join me. So he'll be coming up here. I'll let him say hi really quick in a bit.
Hi,
And
guys.
this way, anything that might be a little bit too industry talk jargon-y, he can try to help ask those questions. And also, I think Tony has a great audience who has really good questions that I may not have seen. But I'm going to give this quick kind of recap of fractional reserve system, fractional banking, and then try to answer some questions as relates to what does that imply for the other banks, a little bit more full discussion of that, as well as where might be some safe places to put your money. And then we'll take questions from the audience as far as that goes. Okay, here we go. I'm going to share my screen. Past performance is not indicative of future returns. At this point, given what happened on Friday, I have no long positions in any financial company, period. In the banks, I had some residual puts that already existed before all of this happened. Okay. And then I do have some short financials in general areas, puts out there. So that's fully disclosed. And I want to show you the reason why. This is a rehash of what I said, just this one slide, but I'm going to go deeper into it because I can see really clearly that even some of the people that I've respected and even worked with for years are posting things because they've gone in this left direction. And really, to compare this to 2008, I'm just going to preview what I'm saying there is incorrect. Period. End of story. Not even close. Even you're a little bit better to compare it to 97, 98, but even then, it depends exactly how you're comparing it. So again, this slide I showed on Friday and on Saturday, Thursday and Friday. I showed this slide. This is very makeshift, but essentially a bank's balance sheet is the exact opposite of most companies. In most companies, if you get cash from someone, you put it in the cash line item as an asset. But for a bank, that line goes into liabilities. They're literally the opposite world of the balance sheet. So from there, you have liquid stuff, which is essentially cash, and it used to be cash equivalents. But right now, treasuries are behaving so strangely that cash equivalents are not cash. So that's one aspect of it. Then you've got the non-liquid stuff. Traditionally, you have the non-liquid stuff, and then you have the non-liquid stuff that can go to less than zero. The problem right now is that the non-liquid stuff is actually acting way less liquid than normal. So I've created a new little diagram called How Do You Break a Bank? How do you break a banking system? Okay, because we've now moved from caring from an individual bank's perspective to actually the larger bank in general. Excuse me, I always have a little bit of a stuffy nose in the morning. Sorry about that, guys. We talk about the CET Capital Ratio in my past videos, and it's come up probably in the news, and probably more than any other time in history, you're going to learn this word in a way that is unfortunate because it sucks. You shouldn't have to learn this word. But essentially, the CET Capital Ratio is the calculation that is made that's going to try to take into consideration, okay, given that you're a bank, and you're holding our cash and we're in a fractional reserve system, how much cash do you actually need on the daily? And on the daily, usually what's happening is like some people are giving the bank money and some people need the money back. Maybe like you're a restaurant. Let's use something really simple. You're a restaurant and you have to go buy food first, and then you do your job and you're a successful restaurant and you make a margin over that, and then you give that money back to the bank, but then you keep some of it, so it's this back and forth on the daily, and that actually is calculated. And then over and above that, there's a buffer. And the CET Capital Ratio, Tier 1, CET1 capital, you sometimes see it. Some people are now abbreviating it as T1C. And then there's any number of ways that people are abbreviating it. But that buffer is your cash buffer. That is very similar to if you're an individual and you've got a little bit of wealth. Maybe you have a bunch of money in deposits, but you then have like a bunch of investments that are pretty good, but if you had to liquidate them on the fly really fast, you'd be ticked off, okay? So CET Capital is just the cash portion of that. The second portion is usually, it can sometimes sit in Tier 1, sometimes mostly it sits in stuff that would not be calculated for CET Capital. Sometimes there's a lot of different places to look at it, but essentially it all shows up on the balance sheet, okay? It all shows up on the asset side of the balance sheet. it's non-liquid but fairly easy to liquidate stuff. Okay, so this means that there's lots of buyers and lots of sellers, and this is where different people talking about it have this approximately right to flat out wrong. And it's, to me, very dangerous to have this flat out wrong because it accelerates a run on a bank. What is this stuff? Traditionally, super prime mortgages to people that you have zero risk at them paying you back, that would be included in this bucket. And just to give you a sense for it, all these people that are attacking mortgage banking are a little bit silly. There is no, that it is one of the most liquid debt instruments, period. Every single pension fund would choose mortgages before they would choose literally any, like even equities, if you go back through how you would calculate risk on these two instruments. So I find it academically offensive, some of the ways that people are talking about this, but calling themselves experts. So this is not great. So usually you would be able to liquidate this fast in the marketplace because someone would just want that yield. And even the little baby mark that you would take on it wouldn't be enough to put you under as a bank. However, we have this really bizarre situation that's happening where a lot of banks, because of deposits being yanked out, which I'll go through again to clarify for people that are still kind of new to understanding bank balance sheet. Because the deposits are being yanked out so fast, essentially the banks, because of the CET capital ratio and how it's calculated, are being required to sell this yellow part, which should have been fine normally. Okay. Normally this would sell, this would clear. There would be no extra additional mark that's taken. But right now it's not clearing the way it normally would because of two reasons. First, because the markets are fairly closed down right at the moment in fear of what's just happened. But number two, no one has the cash to buy it. So this is literally the same as if your kid got sick and it was going to take everything that was in your bank account and you were going to have to go sell something and get the money tonight. You would have to go to a pawn shop, and the pawn shop would literally not give you full pricing on that, even though they know they could easily sell it off tomorrow morning. That's what happens in a bank run, is this non-liquid stuff becomes a real problem. And then finally, the very hard to find a buyer stuff is very low. Okay. And you can see that the importance of me saying it that way is you can see that in literally every single bank balance sheet, not just in the US, but on this earth. Okay. There is no bank except potentially, and even this would not be true because the Chinese government also has a fractional reserve system. It's just the way they lock it down is different. Okay. The way that all the companies in Europe, all the countries of Europe and all the countries in America, as well as Latin America and everywhere else, the way they all lock it down is identically the same way. Okay, so let me go back to sharing my screen again. I want to show you one more time because I said this on the quick the other day, but now I want to really clarify it out because I'm seeing everything across the map on how this is being described. What makes this easier than it was before? Okay, even in the past, and this became a real area of study post 1997, 98. If you wanted to break someone's banking system, there were a few different ways that you could do it. The first is, so creating a run on deposits really just means that you have to create a crisis of confidence in the other two areas that really represent the cash of the company. And that's going to be retained earnings, which on the other side of the balance sheet is represented by cash and a few other things, cash equivalents, et cetera, oftentimes. And, or alternatively, just push the common equity value down to zero. And so there's a certain number that everybody can do this in. Before, you would actually need adequate cash money to create market momentum, and the market momentum was harder to create. But we all know, and it has been said at a lot of different talking head meetings, not the least of which was actually Warren Buffett during his last annual report. It is actually very easy. The market momentum of this marketplace has gotten strange. And that has to do with a lot of things. It has to do with the nature of who's in it, the marketplace. It has to do with index funds that are literally making their investment decisions off of what off of market value, which essentially is a market momentum metric. It is not a fundamental metric. That's just an error that people say all the time. Or alternatively, it can be flat out algo traders that have no thought process on the underlying companies and will just trade momentum along with it. Market momentum in 2023, during this period of fragility, generally speaking, in the world, is easier to create than it has ever historically been. That is what makes this portion of CET Capital riskier than it's ever been. Common equity value is very easy to push to zero. And by pushing common equity value down, you also necessarily create a correlated effect on debt, which we have talked about in the past from time to time. But you will see that if you're a little bit more advanced, and I know some of this is really advanced jargon. If you are a debt specialist though, and you have some more background, you'll see that in spreads widening. The spreads widening are just correlating to the common equity value going to zero. If you're an AMC shareholder, you kind of probably already know this, because you know that the debt portion of the balance sheet went to 30 cents on the dollar, and Mr. Aaron bought that back because he didn't believe that that was correct, and also it had an effect on the equity side. So these things are 100% correlated. All you need to push a bank into bankruptcy is to get enough market momentum, and the way that you typically would do that if you're aggressive and antagonistic to this market is you just push the common equity value down. That is what we need the regulators to come out and figure out a solution for. So let's go back. Let me think. So then implications for banks and banking businesses. Let's actually go through the first one really briefly. I don't have aggressive things on the others. Here are the regional banks, okay? I cover, as you guys know, 400 stocks in the S&P 500 is what I try to read through. Because of this week, I'm a little bit slow. I was supposed to be done this week, so I got another 50 left, but I definitely have covered all the financials since they report first. This is how the S&P 500 banks laid out at the end of the quarter. So CFG, which I talked about, Citizens Financial was decreasing the book, increasing CET Capital. Comerica, First Third, First Republic, yeah, the ones that everybody is kind of coming after on the regional, and Huntington were all decreasing the book. KeyBank, it was a little bit not straightforward what they were doing, so I'm not sure, okay? M&T Bank, they were unclear as well on the call what exactly they were doing. Regions was probably the most aggressive, saying we are going to hedge it out. We're locking it down. We literally don't care if we make more money. What we care about is not losing money and going under. So they were very aggressive about it. However, that said, they are still in the fractional reserve system. All these banks are in the fractional reserve system. SBNY was decreasing the book and increasing CET, but because of the nature of what they do, it is a little bit harder for them, just like it is for everybody else. Silicon Valley Bank, we know, is gone. PNC, they took a massive write down on everything crypto, and then they went into defensive mode as of not just this last quarter, but the quarter prior to report the previous quarter in January. TFC, this one's a tough one as well, because you've got so much growth in the southern states. They wanted to take advantage of some of that. And then Zion's Bank decreasing the book was what they were saying they were going to do. So that's where everybody laid out. But the fact is, they also are beholden to the things I just said here, which is all you have to do, there's a buffer, then you got your non-liquid piece, and all anyone would have to do to hurt them if they were doing it viciously is attack the common equity, reducing the CET capital buffer, they have to come up with more buffer for the CET capital, and then say la vie, you're down and you're bank run. Now let's talk about the investment banks. The investment banks can use two things there. They can use both the CET capital ratio and whatever they went ahead and took for, and this is true of every bank, they can also take whatever they're taking down in reserve losses. So some banks did take an additional reserve against potential issues like this. So Morgan Stanley, Goldman Sachs at 14%, Raymond James at 26%. Schwab, it hurts my soul to say this because I am really impressed with what they've done with the bank, 7% tier one on their 10K. What they've done to change that subsequently, hopefully they'll come out and announce. So with Schwab, even I'm kind of like moving it out. Sorry, that is what it is. but this is about being honest with everyone. Your consumer banks are also beholden to these kinds of CET capital requirements. Here's what it looks like. American Express, 21%. Capital One Financial didn't think losses would happen, so they actually started to be a bit more aggressive. But and if anything, they were probably winding up, not down, the consumer lending book. That has to do with some of the things that we talked about on Friday, which is that it is true that if no one is lending, you can charge a lot more as a lender. So that kind of is what it is. Additionally, when people need loans and you got me, okay? Discover Financial usually does bank a lower segment of the population. They were, ever so slightly down on CET capital. We're talking about like 14.8 to 14.3, but they were taking additional reserves down, which means holding cash. And then they were being very conservative. SMB Synovus was at 9.6, and they were kind of neutral on the call. And then Synchrony Financial was neutral, and then they have about 12.8% reserves. This is all kind of their stamp that they did in January to talk about what was going on in December. Now, where then could you put your money? And some of this is actually, I'm seeing it, and some people are saying put your money in a neobank, which is kind of not a bank, but is a bank. In other words, it's not a bank because it's not protected by the FDIC, nor is it acting as a bank. It's more some other portion of the financial system. And so when you give your money to a neobank that isn't attached to a bank, it's not a deposit at that point. It's just held in this like almost ether, quite frankly. Literally, it is held in the ether. There's not another way to say it. And I'll kind of try to talk through it later because I do think this is not straightforward. But essentially, there are three that actually would be the safer. And then everything else, that's you at your own risk, because I'd have to go institution by institution. And there's a lot of fintechs. But mostly these three I can tell you with clarity because they're in the S&P 500. And I literally listen to them every quarter. So this is what the three are. And even I might, by the way, I think I might do some of this on Monday, just for safety's sake. They are the three non-bank payment processors. When it's held in payment process, you may not be able to get access to it, but if you're buying your groceries with a MasterCard or Visa, you can still use it. And so Visa and MasterCard they hold $0 and 0 cents. It just clears, okay? So 13 billion in cash against 20 billion in long-term debt, none of which is due in the next 12 months for Visa. Because they're not a bank, they don't have to sell or do anything to make CET ratios or anything like that. That's not the nature of what they do. All they do is payment processor. And so when you give them money, they don't actually Visa definitely has a corporate bank that it corporate banks with for its own daily needs. But technically, if you gave Visa extra money, they would hold it. And if you needed it back, they would just write you a check. And so the delay is the time it takes between you giving them the money and having them just hold it, running your balance down, and them giving you the cash back. Now, this is credit card. It is not debit card, which works differently, guys, okay? And I won't go through the difference in this because literally that is its own long discussion, okay? MasterCard, 7 billion in cash around 13 billion in long-term debt. The long-term debt is not due anytime soon. And again, they don't have to make CET capital either because they are not a bank. And so that's 274 million due immediately, but plenty, ridiculous amounts of cash to hold against it. So you can also do this with your MasterCard. You cannot, however, do it with the cards that actually are a bank, which I will go back to because some of you guys are hearing the first time, so you didn't maybe understand why I was giving the last slide. PayPal, technically you can do it too, but because of the nature of PayPal, it's just baby hair more risky than Visa and MasterCard. Baby hair is what I'm saying, okay? Because they have 40 billion in funds payable. What is funds payable? Funds payable is someone that's on PayPal system and they've sold a bunch of stuff. And so they haven't yet moved it to their bank. And they're probably really stoked they haven't moved it to their bank today. Don't move it to your bank yet. Is really the answer to that question. So it's not my favorite, but they should be fine. They have 7 billion in cash against 10 billion in long-term debt. But it just really is how would they wind down funds payable if funds payable had to be liquidated immediately. That's the reason why I wouldn't necessarily be like PayPal is my first bet. Okay. It would be my third after Visa and MasterCard right at this particular minute. Now, some people have asked me about gift cards. Actually, not the worst, not the worst suggestion of all time, strangely enough. Now, there are gift cards for Visa and MasterCard, as you guys probably well know. And there are gift cards for like Starbucks, et cetera. And what you want to do is realize two things. Number one, you want to realize that you probably cannot get a check back from every single company that has a gift card. Some you can, some you cannot. Okay. The second thing is that if that's kind of intriguing is if the company went bankrupt. The second thing really is that some gift cards expire worthless with a certain period of time. So if you've had your Starbucks gift card for like 10 years or something like that, you really have to double check the terms of agreement on the back, that they're not just going to say, all right, we give up, we're writing you off, we're just like, we're giving you nothing. So you do have to check that for each and every gift card if this is how you plan on playing it for your family. Okay. Then the other thing that's interesting about a gift card is that to the extent that the second part isn't there or true, then you technically become, you move from being in the deposit, you actually become a debtor to the company if the company goes under. So it actually puts you in a better spot in certain circumstances, so to speak. Okay. Let me see. Did I prepare anything else? Okay. Stuff on Twitter that I just want to address very briefly. Treasuries are toxic. No, they're not. That's not the definition of what a toxic instrument is. And really right now, this run on the bank could actually make people seem very right as relates to the debt, all that other stuff that we have in the US. It certainly would be the case. I'm going to go ahead and say it. It certainly would be the case that if we were not in a deficit, but in a surplus like other nations, we would be better able to defend all of these banks. But to call treasuries toxic is kind of not accurate at all in any way, shape, or form. Mismanaged balance sheet by the banks. I want to address this once again. You have no control as a bank. You have zero control as a bank over customer deposits, period. Right? You really don't. And also you have zero control over you have zero control over your common equity value. That is unfortunately the markets that get to control that. You do not. Okay. And so I think that's very unfair is really the way to say it. And I think it, like, you kicking a man when they're down. I've never had anything but a certain enmity for that. And then the third thing, mortgages are a thing. Yes, technically they are, but no, if you focus on that, that is not going to solve this problem, because the way that mortgages being a thing is really to the extent, again, that it goes through that CET buffer and goes into things that traditionally would have been liquid, but now are no longer liquid. It's President Biden's fault. I mean, look, I'm not political, and you guys know, anyone that knows me personally knows that I take shots at both sides just as fast as I can. But in this case, it's not necessarily his fault. Now, do I think that he needs to say something? Yeah, he should. He's the head of but whatever. And then gift cards, I already addressed, and that is actually all I prepared. I'm going to bring Tony. What parts were totally help me out? Were there questions that you're?
That was a very good high-level summary. I guess I've got a couple questions for you that you could probably, based on your expertise, help some folks out with. There is this other theory going around that, JP Morgan's going to be the next to fail because they have $47 billion in unrealized losses on their held-to-maturity securities. But there is, in that discussion, there's never any follow-on discussion about what their total asset side of their balance sheet looks like.
Yeah.
Should we even be focusing on held to maturity securities, even if they have unrealized losses? But so that's the question. But Silicon Valley, for example, about half their assets were on these HTM securities. And I look at JP Morgan, it's barely 10%. So I don't even know that we could be making that comparison.
Okay. Held to maturity is a thing. It's absolutely, if you go back through some of my stuff, on banks in general, and also on neobanks, the held to maturity part is a big deal. But Here's what I have to say about held to maturity. first of all, with Silicon Valley Bank, 50% held to maturity would not, especially given what the nature of the stuff was, wouldn't have been a big deal.
Right.
To be fair,
if there was no bank run.
If there was no bank run, because and again, that slide, let me keep the slide up just in case it's helpful for some people that are coming in a little bit later. I'll keep it up for a little second, but then the screen just gets almost impossible for people to read. Right? Those that would make this situation harder to understand than your own personal finances are not necessarily doing a service. Uh-oh, that makes it impossible to see. Let me try it this way. All right.
There you go.
We're not really doing a service to people. Okay. So the held to maturity asset, the held to maturity stuff is really here. It's non-liquid. In the normal circumstances, it's non-liquid, but easy to liquidate. Usually there's lots of buyers and sellers, but essentially focusing on that is not great because right now, especially on Monday morning, every single asset on this earth probably has become held to maturity. You know what I mean? Because until we get some real clarity from the Fed, the point isn't whether or not those were written, plus or minus what they should have been. The point is that if you don't figure out this buffer, you will absolutely have a bank run. Now, just to give you some context on, there's 1,000 things that the Fed could do. For the record, the Chinese, the way that their banking system is run, is they're actually totally cool to increase and decrease the fractional reserve requirement. Ours is a hard number, 8%, but it doesn't have to be, just FYI. Okay. But do I think that if they did that, it would cause other residual impact to the banking system? Yeah, I do. So I think they have to figure this out, and it's going to be smarter people than me, period, by a lot. And that is what it is. But it's that. So I think it's great that people are doing this calculation, but I think they might be missing the forest for the trees.
Yep. There is, like we were discussing earlier this morning, there really is no stopping it. If people lose confidence and start a run on the bank, there's no way out of it. So not panicking is the first thing. Yeah. The second thing that is a common question going around right now, let's ease into this. I think the concern right now is if Yellen or the government don't bail out Silicon Valley Bank, which it looks like this morning she's saying they're not. I don't know if you saw that news item this morning.
I know, I did see that.
So everybody is concerned then that the regional banks are going to be under pressure because and the question that ties in with that, why would regional banks be under pressure? Because everyone's going to move their deposits over $250K to a bigger bank like JP Morgan. And everyone's saying, well, why would they do that? So can you talk about that and about what banks are considered too big to fail? Why would someone tell someone to move your deposits to JPM?
Okay, this one is not the best answer in the world, and because it actually implies something pretty nasty, to be fair. Okay, I'm going to go back to this slide and the implications of it again. I'm glad I actually put some slides together, I guess. Here's the thing. The only reason that you would move it to one of the top 4 banks isn't because they somehow did something better than the small regional banks.
Right.
Okay. It's because it takes more money to take them out at the knees. There's really not another way to say it.
Wouldn't you also think, though, it's because the government would not let JP Morgan fail? They'd do whatever they had to at the end of the day to not let that bank fail versus a regional bank.
Yeah. I mean, that would be the second reason, would be that it just happens that they're already on these too big to fail lists. And so everyone that's been identified as too big to fail is just going to luck out because they're quote unquote too big to fail. The fact is, if you take all the regional banks out, like you just taken them out, you actually have already created the failure. So you decrease the timing of a failure, but it's not like you actually stopped a failure from happening. And the real, if you want it. So what I think is cute is that everybody's going to the mortgages as the knock-on effect. The real knock-on effect that's nasty is the US dollar and also the residual impact of foreign banks. Because guess what foreign banks hold? US assets. You guys, we have the biggest debt capital markets, period. So there is no one else. That is why we are the reserve currencies. One of the biggest reasons why is because you can, it's really hard to get disparate amounts of debt across the entire world. Our mortgage market is actually one of our greatest assets. The 30-year fixed instrument was one of the greatest innovations that gave the US a bunch of assets. Okay. It's like it's almost dishonest, but I don't want to say that, watching what people are saying, knowing that their brain is bigger than mine. Do you know what I'm saying?
Yeah, yeah.
It's really hard. Okay. Hopefully that was
So
clear.
do you think another common question is as far as the safety of your funds? There's a lot of average people out there right now wondering, what do I do? Like, I think the general advice is if you don't have over 250,000 in any one account at one institution, you're probably going to be okay. Is that a correct assumption, or do you have a
Okay.
correction for that?
This is what I would say at this point, because it really depends on how it plays out in the next 3 or 4 days. The first thing I would definitely do, like if you're like May, small town May, who grew up with a lot of people that needed like, real help to get through it on the week, on the monthly, right? And then whatever they have in their bank account now is hard won. This is what I would do. I would actually take enough cash out to meet your personal needs for the next 3 months at a minimum.
Okay.
Just give it time, right? Just to actually have enough cash in your house to like be okay for the next 3 months. Okay. And, as relates to rent and stuff like that, your landlord's in the same boat. So if, just be prepared to have a conversation with them about what's going on. Number two, what you're saying about FDIC is true, but realize it's still federal deposit insurance, right? And
Yep.
even though the US government isn't going to take you to court like regular insurance would, there's still a time delay on timing. So that's why I say take enough for your family to at least be able to buy groceries and stuff. Like, I know that sounds really crazy, but it's just the right thing to do. If you knew a hurricane was coming, even if you had extra cash or extra water in your house, you don't care. So, that's like a real thing. And then from there, definitely the FDIC insurance, you will get paid back by the US government. At this point, it's not there yet, so to speak. Okay. And then the second thing I would say is if you have a credit card, strangely enough, I actually do think it's not the worst idea. If you know that your monthly payments are X, go ahead and put the next 3 monthly payments on there. If you have that much cash and you're just a rock star like that, go ahead and do that, because it's not a bad idea. Those guys don't have anything due for a while, especially if it's a Visa card, which I just showed you. American Express, unfortunately, is a bank. And so the entirety of what their business is going to be held a certain way. Now they're very conservative, American Express. So this is not to throw shade on any financial institution, period. 26% is what they're holding in that bank for CET Capital. So they're going to probably, if I were at American Express, given how conservative that group of people is, they're going to start trying to reserve against that more aggressively to protect the banking side of that. So just realize that that's also a thing. And I wouldn't be surprised, especially how smart those guys are, if they were able to fully support all of anything that's on the banking side of that business very quickly. And yeah, from there, I think that's the best I got for now.
All right. Second follow-up question related to that. Do you see any advantages for the individual, the small-time guy, for credit unions over banks? And this is a multi-layered question, but let's just address the immediate concern right now as far as risk.
Yeah.
Risk.
As far as risk goes, the thing is, oddly enough, if it's a privately held bank where the common stock portion of it cannot be traded, is not traded at all on exchange, then that actually isn't, you're not wrong in that regard. If it's a fully privately held bank where it cannot be gamed in the marketplace such that the common equity marks daily, because really this is a mark to market risk, but it's oddly enough a mark to market risk on the common equity. So that, if your bank doesn't trade on exchange, not the worst call, to be fair. The second thing is most credit unions do have deposit insurance. It's just not FDIC insurance. They'll go to Lloyd's of London, they'll go to Berkshire Hathaway, and that's what they'll do. If anything, I would love to hear, like, I personally need to review business, like, line by line item, whether business insurance covers this for any number of things. So that, if you're an analyst, all these people going through mortgages, that doesn't make you look clever in my eyes. But if you're going through business insurance right now and seeing who has the liability, that makes you very clever. Please call me. Please give me that information. I'm intrigued. I would like to know. So that's a thing. I don't know if that answers.
I think it's maybe safe to assume, correct me if I'm wrong, because again, not 100% my area of expertise, but credit unions probably aren't levering up and getting themselves as much at risk as your bigger banks are too, right? They're just doing your basic home loans, car loans, personal loans.
Well, all of it is going to be leveraged. So
right.
even
It's all fractional banking, but
yeah.
As far as what people are concerned right now, they're concerned about the derivatives and all these other things. If I get out into the weeds, there's a lot of things people are concerned about why these bigger banks could fail.
The bigger banks are going to fail only to the extent that they also are beholden to the fractional reserve system. Right this minute, okay? It's not the toxic stuff that's doing it. It's actually the relationship. The thing that's toxic, if you really must know, if you're like May, you have to call something toxic. The thing that's toxic is the fact that these things are publicly traded, because the thing that's changing in value the fastest right now is the common equity value.
Right.
It's this thing. This is what's getting attacked, common equity value. It's not any very specific asset class that only a very few set of people could buy and sell to begin with. So with the big banks, it's the thing that supports the big banks is that they just have so much more common equity. But again, like I said, you don't need to actually short the common equity to zero. You just have to get enough momentum behind you to where it hurts them on the CET capital calculation itself. So the big banks, are they safer? Only because of that. That's why I say there is a time horizon to how much that can help them out. But the credit unions, a lot of them, you're right, they don't have to mark their equity value at the end of day like an equity would automatically do. So oddly enough, also the other place you could put it is if your asset manager just has a cash account that they're not then putting into a bank, which is very rare, unfortunately, then you could technically, no, I don't even like that, because ultimately all the banks, all the asset managers, everybody still puts the money in a bank. So then it comes down to which bank did they put it in, and is that bank healthy? So it's not great. Yeah, sorry guys.
I think I ran through the major questions that I had that I've been getting all weekend. I've been following this all weekend too, but not wanting to throw out a bunch of videos until we got an update from Yellen and the feds here this morning.
Yeah.
Hey, excuse me for 1 second. Can you take me off camera for a second,
Sure,
May?
no problem. Okay, let me just look through. There's so many questions, guys. I'm really sorry. Okay, the Madoff Ponzi scheme wasn't related to banks as far as it goes. So and also Madoff is just such a different situation. Okay, Madoff wasn't a bank; he was an asset manager. If you want to categorize what style where he sat, asset managers are not FDIC insured, but they may be covered under business insurance, which is why I say it that way. But the FDIC should cover losses for any bank that is FDIC insured. The challenge you have is just the timing. Typically, they should be able to cover it all very quickly. If every single bank, if we get a serial correlation, I'm going to use the fancy words. So you guys, if you see these fancy words, you'll know that you actually have the answer already. If you see a serial correlation between the banks defaulting, then it's really about how long it will take for the FDIC to be able to cover all the losses across the banks. This is a run-on bank issue. It's not a asset specific issue that is just someone failing to have done risk metrics correctly on it. Run-on banks they're very they're exogenous risks. The only analysis that a bank would have done on this is called scenario analysis, and it would have just been a shock to all assets. So all assets would have had a shifted loss, an impairment associated with a run-on bank. And the weird thing is that it's unprecedented since World War II for the US dollar or the US banking system to specifically have this type of run. That's a longer story, but foreign banks would have actually been doing this analysis on the regular, and they still would have been shocking it relative to the US dollar. Hopefully I didn't say that in such a confusing way that made it impossible for other people to understand. All right, I'm going to bring Tony back. Cool. I'm trying to look through these.
For anyone that's holding Silicon Valley Bank stock, that's pretty much toast. I think it's safe to assume at this point, right?
Yeah, it is. It is. Possible solutions that the FDIC could do. Oddly enough and scarily enough, it's not really even a capital infusion you need. You need this specific action to stop. Here, again, back to my little slide. You need momentum to stop attacking the common equity value of all the banks. That would be one of the
for the layperson, when you're saying attacking the common equity value, what we're saying here, correct me if I'm wrong, is stop shorting the stock price.
Yeah.
Right? Or stop selling.
Exactly right. Yeah, oddly enough, it's now the case that all of the banks are in the same boat as the AMC shareholders are. I mean, the irony of it isn't lost on me as a AMC reporter as far as that goes. But yeah, that's what actually needs to happen. So you could see them freeze the shorting of stocks on Monday. But the real question is whether that stops put buying, which is essentially going to do the same thing, or whether that stops the overseas shorting of the synthetics. Oh my gosh, all that work that the AMC shareholders have done on short selling is now making all AMC shareholders probably.
They've also been predicting bank failures for 2 years, by the way.
I tell you, full credit, guys. I only
this community is ahead of the game.
Head of the game. I don't know another way to say what you actually need. You need this mechanism to end.
Here's a good question from Hey Animal. Did Janet Yellen allow this much over leverage? This gets into back into the basics of fractional banking.
Yeah. This one is really, really tough. Okay. So the only thing that would have happened,
it's really the fractional banking.
Yeah, it's really the fractional
and people running to get their money out that is causing this problem, not over leverage.
The only thing that could have been changed as relates to the US having a stronger balance sheet is less moxie to do it, quite frankly. Do you know what I mean? Because at this point, you're going to depend on FDIC insurance. So if you were trying to specifically, that's why I have this really weird, but I'm not taking it down, I refuse, this really kind of 1 minute short that until I know it's not a terrorist attempt, I'm like out of this market for a little bit, is because legitimately, if you were trying to attack the US government through its banking system, this would actually be one way to do it, because you would basically collapse all of the public banks, forcing the usage of FDIC insurance, which would absolutely draw down tax dollars and the various things that are our budget. The same way that it would, I mean, like if you think about it, like everything you know about your own personal budgeting and your own personal financing is somewhat true as well of the US government, except the US government gets to print money and we don't. So I don't want, yeah.
That was the one question I wrote down here while you were talking at the beginning that I haven't asked yet. And you just danced around it. Do you think someone is targeting the US banking system?
I don't know is really the question. When I first looked at the trading, because there was so much, it was both the amount, the quantity, and the size in the first 20 minutes of Friday's trading. The first 20 minutes of Friday's trading, the weird thing is, like, so I graduated, I'll go ahead and admit it because I don't care, I age well. I graduated college in 99. So the last year and a half of my schooling, and my undergrad is actually poli-sci, and I was focusing, which they shuffled a lot of Chinese kids into this area, was China, right? So China had a very particular banking system. And specifically, we were coming through 97, 98. So we were learning about the different regimes that were being toppled by their banking system going under, and the Chinese, what then would be the Chinese government's play. Sorry, it's like I always get really sensitive to talking politics of this nature. So when I first saw it, the trading pattern, it looked like an attack against all the common equity across all of the banks, right. Not just because all of them were down, which you'd expect no matter what, but because of the volume and size with which they were coming down. And so I was like, whoa, if that's what this is, I'm out. You know what I'm saying?
Yep.
But now I don't know is the answer to the question, right? And there's a lot of people that would have an interest in seeing this down, and I don't and quite frankly, it's not necessarily foreign governments because they hold in their reserves also U.S. dollar.
Yes.
So there's that. The more likely candidates would be your misguided folks. So I saw on Twitter a lot of misguided folks that think that Bitcoin is the end winner of this, and it is not. And it is not because for all of the brilliance of the innovation within crypto, and I really do want to say it that way because I'm not antagonistic to crypto. For all of the brilliance, the one thing you still haven't done is figure out a way to make crypto pay for food for kids. Do you know what I'm saying? And so as long as that isn't there, even though I watched Mr. Robot like everybody else, it was a great show, the fact is you guys are still doing a fight between yourselves on which cryptocurrency is going to win. And given that that's the case, given the lack of fungibility, given the fact that you still haven't solved attacks and hacks on your own systems, but oddly enough, the kludgy paperwork system that we have in the traditional banking does actually make it harder in the worst possible way to get your money out or to get hacked. You're not a solution. Sorry, I'm just going to say it like it is. But
You're speaking like you're not a crypto investor.
Look, I got worried, I got worried about all things on Friday, but I have it for many years been long just Bitcoin to try to because I do believe in the innovation. But then I've done also projects on different crypto companies reading their white papers. I'm like, oh, you're lucky that people are hired to do something else for a living because this is really easy for me to hack. Or alternatively, this is really easy for me to show you exactly how this goes to zero. For example, but not the major cryptos don't do this. This concept of the bonding curve literally gives me the math for how to take your cryptocurrency to zero. So any cryptocurrency based on a bonding curve, you've completely misunderstood market dynamics at that point. You need to spend more time on an FX trading desk is what that is. Do you know what I mean? Yeah. So that, unfortunately, I saw way too many white papers during that period of time to think that crypto is the solution at this particular moment in history. Okay. Do I think that digital banking and moving to digital banking is the right call? Over time, yes. Solving many of the problems that exist, yes, is what I'm saying. But just imagine this, right? Circle, which is a very smart set of people. I've seen that guy talk. I've seen resumes of who he hires. It's not like there's lack of brain power, but ultimately, because it's a stable coin, if you attack the underlying bank that actually is custodying and so is potentially the right word.
Which happened, you know that, right?
Yeah, absolutely. That was Silicon Valley. Then you will collapse the stable coin, which is exactly why I posted what I posted on Friday, which is, central bank digital currency, or I posted it maybe as a part of the congressional hearings with the Fed. If you attack the underlying banking system, central bank digital currency solves a lot of problems, but at the same time takes a lot of players out. You will still potentially need an instrument that looks a little bit like a stable coin, but it will probably, and I didn't finish the sentence because I'm still getting good at getting in the tweet 280 characters thing, but finishing the sentence, the stable coin that remains will essentially be an FX, the FX ticker trading instrument. It won't be a bank or currency at that point. It'll be as much a currency as if you're trading USD, USD, name your favorite other currency, USD yen, right? It'll be that.
We should do schedule in a week or two, another live stream just talking about CBDCs, because that's a very popular topic, but I don't want to derail the banking thing today talking about those.
All of these are such big topics. It's crazy.
Although USDC right now is under pressure. I just before we came on, it was trading at 95 cents, and we know it's been under pressure all weekend. What are your thoughts on gold and silver? Or people are wondering, should they move to metals or just take cash out of the bank?
Well, okay. So the one thing I will have faith in, but you know what? I got to tell you, this is going to be the biggest test of all time of the regulators. And, we were fortunate in 2008 to have certain brain power come up to help it out. Let's see how it goes. Do you know what I mean? Now, I forgot the question almost at this point.
Would you recommend to anyone, to move some of their money out of
Into
stocks or
gold.
even cash and just go into gold, for example? But
Yeah, actually,
then what kind of gold are we talking about? Are we talking about physical gold, or how much can you do in a day? I mean, if it's going to get messy, it's going to get messy fast
so
on Monday, I think.
yeah, I bought the gold ETF. Okay. And here's the
That's
thing.
all I've ever bought is GLD. I'm not
Yeah,
holding any now, but that when I trade it, that's what I buy.
the gold ETF is held by a company that is not a bank. So that gives you time. So some people have posted correctly, and then this got miscovered, that like there is a duration mismatch, meaning like there's a time component. And right now the banks are being held to that time component like the very next day. So this is literally everything. If you're very learned on 1997 bank crisis overseas, that actually holds. The asset managers are not beholden to that. So they actually have nice, happy, easy time to like sell it off. So actually the ETF gold isn't the worst option for you to put your money in right this minute, because even on a bank run, the underlying asset is gold. So it's however they're managing that, whether they're managing it through the gold future or whether they're doing it some other way, doesn't matter. And then they'll have time to unwind and pay you back because they're not beholden to CET capital ratio requirements. Okay.
Okay.
So pretty much all of the commodities, and quite frankly, in 2008, commodities, this one sadly is emblazoned in my brain because it's legitimately what I did for a living in 2008. The commodities had about 6 months before they started to collapse with everything else in 2008. So Lehman happened, the price of oil shot up, as did all the other commodities, and then it took a nosedive sometime circa like I want to say like July, August.
Okay. Well, that might be some good info for people. The other thing common in the general investor community is this theme that, and I don't really have a comment on it, but I'm curious what your thoughts are. I don't know if you've heard this or not, but there are a lot of people actually praying for the breakdown and the failure of all these major banks to cause short squeezes in specific stocks.
Oh, guys,
What?
you might get 30 seconds at that point to get out. But, when the tide comes in on a liquidity squeeze for an entire nation as big as the United States, it's coming out of everything. Nothing will be sacred. And if a bank goes under, guess what happens to your asset? You may or may not ever be able to get the cash out of it. I think you just kind of stay put right at the minute.
And it might actually, it could avalanche into something so bad that they just shut the entire market down
Cool
until
off.
everybody can take a breather, right?
Yeah,
It might not get to a point where one stock squeezes because JP Morgan fails.
yeah, that's
It's a,
very.
it's a little bit of an unknown. I just was curious what your initial reaction would be to that question.
It's not a bad question, because I know some of you guys, you got no skin in the bank portion of the game. You only have skin in the securities market. I get it. Like, it's a legit question. Okay, what will necessarily happen on Monday, even if there's an announcement, is that anybody that still has, so there's these, I always use the word exposure, and sometimes people are like, why is she using that word exposure? Okay, because here's the thing, the financial system uses this word exposure because they're talking about what are they exposed to, both long and short. So that number is often called the gross number, just like it would be if you were, in anywhere else, right? So the gross exposure, so the other word that's associated is risk off. Risk off, meaning like, I don't like the amount of risk that's in this marketplace, means that you will take your gross exposure down, both long and short. But because in general, all marketplaces everywhere are typically more long than short overall,
Right.
then what that means is everybody's going to cash. And that creates a sucking sound both on everything that is long and short. So at the end of it, even though you get maybe a few hours to a day of strangeness, maybe you get a pop because of it, ultimately everything goes down.
May, what I'm hearing you say is you're saying there's a chance.
There is Potentially. That is true. There is a chance. It's just that once you get it, you better hit it really fast. Is really what it is.
Sleep
Because
with one eye open, guys. Wake up in pre-market. You never know.
oh my gosh. Yes. Unfortunately, that's why I haven't been mean to anyone that's asked me that question or been like, what are you talking about? Because what happens on Monday comes down to market mechanics if they can't come up with a really good solution. Now, if they come up with something that is so amazingly innovative, then yeah, this market will go straight up because this market deflated like crazy on Friday. But you know what I'm saying? But so it's really not the most straightforward thing. And I'd really encourage you guys, if you're on the nerdier spectrum versus the hey, I'm just trying to feed my family spectrum of watching this, I really encourage you to learn about Warren Buffett, because oddly enough, part of the reason he has always 100 billion in cash money is because he never wants anyone to be able to attack the various companies of Berkshire Hathaway. Also, additionally, the other place, I'll just throw it out there, but maybe it's a different discussion. The other ways that banks can protect themselves is actually to buy back their stock at a discount. So all of this negativity towards buybacks for banks specifically, this is why they do it. Do you know what I mean?
What are your thoughts on what's going to happen Monday? And then we got core CPI, just like 1-2 punch this week on Tuesday morning.
I don't know.
This is going to be a crazy, crazy week potentially coming up here.
I'm just going to go ahead and admit I have no idea what will happen on Monday because I really don't. I mean, it's so dependent. Usually it's an obvious group of people, but if you just get look, the United States is a wonderful, I'm a patriot. I posted that I was worried about terrorism. Okay. And I got off my trades. But the fact is, if you look at the population of the world, it is at this point, it's us and whoever are our friends against them if they really wanted to push us at this point. Do you know what I mean?
Yeah.
That scares me. I don't know the answer. And I don't know if the asset managers and the truly despicable portion of the asset managers are more greedy than they are more patriotic. Do you know? Or if they're more short-term greedy than they are patriotic. I really don't know the answer to that. But
I'm pretty sure they're more greedy, honestly.
But you never know. You never know. You know what I mean?
But you do, May. We know.
Okay, I will say this. Warren Buffett did actually step in and help during Solomon Smith Barney in the 94 crisis, okay? And he has told us that he will never do that again because it was so painful what he had to go through as a patriot. I mean, he's got 100 billion, so he may step in and help an individual bank. But I don't know that he's going to be so crazy that he'll step in and help all the banks. And then it's really oh gosh, it's so bad. I mean, if they all on Monday, if they all suddenly find a way to take themselves private, that would take the pressure off of this mechanistic situation.
Yeah, I don't see that happening.
No, it's really bad.
I'm trying to see if I have any other questions from my viewers. May, your expertise on this topic is much appreciated. Any just I'm going to call out one ticker. Any thoughts on SoFi with in light of what's going on? I know you were talking about neobanks earlier.
I don't. I have to review their documents. They just became kind of a proper bank and we're trying to move their capital ratio up to FDIC. So I remember the last time I looked at them, but I haven't looked at all of it. It's so sad too, because if SoFi goes down, Anthony Noto is really a smart guy. I have a lot of respect for him as a person, but it almost doesn't matter. This is literally the wave is coming in and it's going to be ugly one way or the other. So I don't have a great answer.
Okay.
For any and all of the neobanks, if they suddenly get bought at a discount and just disappear, then you might be okay. Also, for the neobanks that don't have to mark, that's one thing, but realize that neobanks also bank with someone. The cash doesn't just magically sit in the ether. The cash goes somewhere. And so whatever is that underlying custodian of your money, that's the thing you have to check. Unfortunately, the underlying custodian of Loz's money is just banks. Do you know what I mean? It's quiet. Are we done with questions?
I'm reading questions, looking for a good one to see.
I know there's just so many.
Yeah, I see a couple people commenting. Elon was like, I would consider buying Silicon Valley Bank, but
he's not wrong for that, because legitimately, the tricky thing is a bank is usually valued in part on its assets. Okay. So the deposit portion of the assets was to zero. But if you just became the depositor, you would own, if you get the right price for Silicon Valley Bank, that's why, because Silicon Valley Bank isn't filled up with truly toxic assets. Are there some things that are on paper overvalued? Yeah. And here's the thing that makes that a silly statement, because as long as no one's buying, all assets are, you know what I mean?
Yeah.
So
Yeah.
then so those assets do give you essentially a yield, you know? So it's just that the principal component of any bond is going to be what the market marks them at. It's not even what the credit rater says that the bond is worth. And so if you have actual cash money that you can just hang out with and you don't need the money back right away, then it's not the worst purchase that you'd ever make, depending on what price you pay for it. That's why I think I have this tweet where I said, like, the hedge funds buying these deposits or buying whatever it is, your risk, your liability risk at 50 cents on the dollar, essentially what they're creating is a zero coupon bond and allowing the courts to hash it out. So they're assuming they might be able to get 75 cents on the dollar on deposits alone. It's weird. It's all very, very weird. So what they're saying is that if the FDIC doesn't insure your deposits and also the banking insurance, any banking insurance or any private insurance that the bank had to try to cover the rest of it doesn't, like, goes to court, they think they can, it's kind of like that.
For deposits over 250 going to court,
Deposits
right?
over 250, yeah.
To answer Jennifer's question in the chat, if you have under 100,000, yes, you should be okay. FDIC insurance covers you up to 250,000, although like Silicon Valley, FDIC is opening up their branches on Monday for insured deposits, right?
Yeah.
It's the process of getting more than 250,000. You might be able to recover some uninsured assets, but that could take a while, right? If it even happens. If
the if is a big if. What I would say as well is, if you're at a credit union, definitely almost all credit units will state very clearly the deposit amount that they have insured up to. And so that insurance, the two biggest insurance companies that do that type of insurance is Berkshire Hathaway and Lloyd's of London. I'm sorry, let me say that differently, because I'm not 100% sure. The two probable insurers that do that type of insurance would be Lloyd's of London and Berkshire Hathaway. I'm not 100% sure that they do that type. I'm pretty sure Lloyd's does, though, because I remember something vaguely from 2008. But I'm not 100% sure if Berkshire does it. But it's called specialty insurance. The type of insurance that would send under would be the specialty insurers, and those two are the biggest specialty insurers. That's why I chose them, in case anybody's watching and they actually know Berkshire better than I do. Which there are some really, really smart. There's lots of people that are smarter than me. I'm going to admit it. But if you know that, put it in the comments. Do you know what I mean? Because I don't know the answer to that.
May Cancel Bubbles I saw he put this comment about 30 minutes ago too, that he says the problem with FDIC insurance, it can take up to 6 to 12 months to get paid.
That's correct. Insurance is still insurance. It has to go through courts, or alternatively, the payouts go in a particular way.
So can you explain reconciling that with the fact that the receivership of FDIC is opening up Silicon Valley banks on Monday? Like, what is the difference between those two?
I think Silicon Valley probably. So I think Silicon Valley probably did have some more cash that it's just still remaining in the bank, because it closed down at 3 p.m., which isn't enough time for all the transfers and everything that was probably happening at the crack of, like, on the morning. So
the FDIC took their assets, right? So is that what, there's assets there that they can pay people out with? Is that basically what we're talking about?
Okay, I probably should, huge disclaimer, no one will ever know the answer to that, but the people that are working on it right now to confirm. My suspicion is that there's still a little bit of residual cash that didn't get dragged out of Silicon Valley when the Fed took it over on Friday. And that's the money. That's where the money is coming from. So
Okay.
there may be a point at which this bank run is still a bank run in every country and every point in history. So if you are a historian that studied the banking disruptions it really is that scene from Mary Poppins that I posted on my Twitter, strangely enough. It doesn't take much to create a bank run. So there's a lot of different one-off banks. Every single bank has this risk. It's just whether or not what's happening it's the speed and velocity with which it happens. So Bank of America has that risk. JP Morgan has that risk. Every single bank so maybe let's make it easier. Every single bank that trades on the public markets has the potential to have someone attack their balance sheet by attacking the common equity portion of the balance sheet. There's not one bank that doesn't have that is publicly traded. The privately traded banks have less risk, but they're still going to be hard up on the CET capital and making CET capital requirements. What typically happens when you can't make your CET capital requirement is you're given a period of time to make it. Okay. But in this kind of environment, it's really hard to do it because you still have people dragging money out of the banking system. So that's what's going on as far as that goes. Will it all wash out okay? Probably. If you're at one of these institutions, like I said, the best course of action is to have enough cash for your family to be able to buy groceries and take care of the most typical stuff, near term. And then from there, just give it a half a beat. There isn't really a safe bank if it's truly a bank run, if it's truly attack on the fractional reserve system. And then again, like we said earlier, it is the case that asset managers are not beholden to CET, and most of them, like BlackRock is over 100% reserved on assets, and then there are some that are as low as 26%, but they can also liquidate. So the rest of the stuff is very liquid. It's just the marks that'll be taken this on Monday. So it's kind of like that. Yeah. And then if you do have gold, listen, y'all know there's a lot of people that have gold in their basement. All right. That is a real thing. But then you're just beholden to the pricing of gold as it swings up and down. My guess is that it swings up on Monday. I'm not a hardcore commodities trader. But that's usually what happens when you have this kind of systemic risk. So I'll let the gold traders tell you in their own personal blogs and vlogs.
Just one other thing, guys. I'm going to do one quick 5-minute video because I know not everybody wants to watch a 90-minute live stream. But just to recap a couple of thoughts. But I'm going to address this question or this thing that keeps coming up. And I was even pissed about it on Friday or whenever I did my last stream about the press putting these headlines out. Oh, the CEO of the bank sold stock coincidentally just weeks before this happened. Did he know something? Is he going to jail? So over this weekend, I did a little more research, and this guy's been selling for, I went all the way back to 2018. The beginning of every year, he's got a 10B5.
Yeah.
Is that?
I think that's, I don't know the actual form number, but it's just, it's not even,
it's a scheduled sale so that you can't get accused of insider selling. And guys, he's increased the shares that he's holding. I looked all the way back to 2018. He had 50,000 shares, and he sells about 10% of them at the beginning of every year. And then it looked like he was trying to cap himself at about 70,000 shares. Anytime he got over 70, he'd sell some. He's holding 100,000 shares right now, even with the recent sell. He didn't dump all his holdings, and this is not some out of the blue unscheduled sale. And that goes for all of the executives. So even though I was upset when I read the headline on Friday, now that I've had time to research it, I don't think there was anything fishy going on there. Based on the timing, I was able to trace it back years and see the same thing. And he's increased his position, and his sale in January or February was not really out of scale with any other sales that he did in previous years.
Yeah, I'd assumed it was a scheduled sale given what I saw what the number was, but I'm really glad that, like I said, this is why I like Tony. He does the work that I don't have time to do. Thank you.
Believe me, if I thought there was something fishy, I'd be running it up the flagpole and screaming bloody murder. But I couldn't pin him. I couldn't pin him to the wall on this one. I have to give him a pass.
Yeah, I know a lot of people are focused on FRC too, FRC as well, and they don't have the same type of customers. They do have some of the same type of look. VCs spread their money across a lot of different banks on a lot of different coasts. But I would say that they also have a lot of exposure to literally everything else. The crazy thing is FRC and Silicon Valley Bank, as much as people are talking about all toxic, all this stuff, you have to realize these companies reported 100% earnings growth in the last 2 years as we actually tried to support the economy and grow the economy. It's really unfair to pretend like these guys mismanaged the assets that they had custody on. If anything, if you think about it, they took it from loans to, they took it from, which would normally be considered lowering your risk. They took it from a company, like, the loans that go to companies, the loans that whatever, what have you, and then they moved it into things that are typically considered safe, which is mortgages, which usually trade no problem, or what have you. Now, those that say that there's a duration mismatch, meaning instead of buying like 1 month treasuries, they bought 10-year treasuries. Was that the right call? Kind of, yeah. It wasn't. I mean, you have to look at how much they had in deposits over how much they had in loans. They had so much more in deposits at the time that this was done, that it's still kind of unfair. So I would encourage those people that are attacking this management team in a way that I find distasteful, because it is legitimately like kicking someone when they're down, to just go back through the balance sheets for all of last year and the previous year so you could see what was going on to retained earnings, which is just cash money. And
Oh,
also,
May, nobody's going to go through balance sheets when we can just read a headline and throw someone
you're
under a
so
bus.
right.
Come
That's
on.
fair. That's fair. That's fair. I
It's
that.
so much fun just to trash them and not
It's
bother
so
to
much fun to
understand
trash these
anything.
poor people who are trying to like actually keep their business in check.
I think it's probably fair to guess that they knew, since the beginning of this year that they were at risk, but the staff all got their annual bonuses, right? Because they're
Yeah.
probably trying to go about business as usual and pray to the gods, both old and new, that the customers would not drain their deposits.
Yeah.
But it didn't work out that way. Like, they had to raise cash once that news got out. Then everybody got nervous, and then all the money managers start saying you probably should take your money out, and it just became this snowball effect, right?
Snowball.
It wasn't mismanagement as much as some unfortunate choices of what they invested in back in 2021, and then the economy slowing down and interest rates going up.
Okay, wait. This one I saw too, and it's a real one. Is the CFO from Lehman? No, the chief administrative officer is from Lehman. But even then, if anything, a lot of people want to hire someone that's already been through a Lehman Brothers, because they can see the writing on the walls and they'll start to do the right things. In a lot of ways, what Silicon Valley Bank did, even in the fourth quarter, if you listen to their call, were the right things. It's just that the market structure itself has changed. It is so much easier to push a company into bankruptcy, especially any bank that's listed, that any bank in the U.S. that's on the fractional reserve system and happens to have, had its funding public. Now, look, you guys have to realize that banks weren't always public companies. Goldman Sachs went public in 1998. I know, because I didn't get any shares. So I'm sure of it. I got that date memorized. So it is absolutely, it was not the case that all banks used to be public companies. So that actually is potentially a solution for the US banking system, but I don't know that you could do that overnight or even do that quickly.
Damrick says his wife's been telling him it's to get the money out of the banks for months. And yeah, Damrick, this is a great time to go buy a boat, my friend. Just take that money out. Say, honey, you told me to get the money out of the banks. Fishing boat.
Just give it another week to buy the boat, because there's going to be some really nice boats coming up for sale here in the next week. Like, you get a bigger boat. You know what I mean? I know you're going to catch some bigger fish. You go out farther into the water.
Oh yeah, this is another good topic. I was talking about it in my Discord, and we haven't talked about it this morning, May. Do you, I already answered my folks, but do you think that there's going to be any, actually, I think I chatted you this morning in DMs. Do you think there's going to be any change in the Fed posture based on what's going on right now towards increasing rates later
There's
this
no
month?
way he increases rates in this. Like, if he does that, I've been such a fan of Jerome Powell this entire time. I've defended that man every single time. But if he raised rates into a banking crisis, I'm done. I'll respect everything you've done up to that point. Let me say it that way. You cannot raise rates when the banks are. If anything, you could actually lower rates just to give the banks a breather and to steepen it back the curve. So this is where the bond nerds are having a field day. Okay,
Yeah.
and I you guys need to back it off because it's actually not as clever as you're way too clever for what's going on. But all of the secondary stuff that's coming out on Twitter that's a little bit less offensive, that would actually be the right thing. So right now, the yield curve for like a while has been what's called humped. Okay. Some people say it's inverted. No, it's humped. And what humped means is that there's massive market uncertainty going on. So humped means that the front part of the yield curve, well, actually, I probably should be closer to this because it's almost flat in front. So the front part of the yield curve is actually higher than, and then there's like some intermediate term, 6 months in this case to a year and a half, that's higher. And then everything else on this side is lower. What's going to happen on Monday, because this doesn't take rocket science. All you have to do is been alive during 1997 and learning about markets at that point. What will happen on Monday is the front part, the overnight money, is going to go up. And then we will have an inverted yield curve. That's what happens. That for the first time, everybody that's been talking about this damn this yield curve will finally be right. You will have your inverted yield curve. Awesome. You're right. Like, what's that? So what was it that you wanted to happen after that? Do you know what I mean? So you have your inverted yield curve. But what you can do is if he raises rates, he will literally be doing the exact opposite of what he needs to do, because he will precipitate the steepening of this yield curve. And if you're confused about that, just go back to 1997, have yourself a look at all of the Asian banks that collapsed, and you'll see exactly what happened. They basically inverted the yield curve to try to retain money in. Now, the only reason that we may be absolved of this need to do that is because, as bad as it is right now in the US, Europe's worse. And China doesn't float its currency. So there's literally no other place for you to go. So actually, you can do the one thing that no other country can do. You can actually shift this yield curve. That's the one thing you could do. And it would take pressure off of the back end. But we'll see if he actually does it, because for every nerd that thinks that, there's bigger nerds that think the opposite is true. We'll see.
Do you want to take this question about if you compare or contrast what's happening right now with Silicon Valley or any other bank that fails next week to the last banking crisis, where they were buying, toxic debt?
Okay.
People are asking why are banks so stupid? Why do they keep on making these same mistakes? Or is it the same situation as what happened last time?
Yeah, it's totally not the same situation. And again, here we'll show this slide because it's been a bit since I did the original part of the presentation. Okay, this is what we're talking about as relates to CET Capital. So this yellow stuff is not toxic. It's the typical stuff that has normal amounts of buyers and sellers. But right now there's no buyers, and there's no buyers because we're in a fractional reserve system where it's really dangerous to buy right now. Like right now, even our friend that posted that he's buying a boat, for a fact that if you just wait a week, that boat's cheaper, right? Like, that, especially if you're hanging out in California, because there's a lot of people that just don't have money coming out of the banking system because they were Silicon Valley Bank clients. And so they're probably going to sell their boat to try to raise some cash. Okay. The stuff from 2008 was this one down here in the black. That was truly toxic stuff, but it wasn't even just toxic stuff. It technically was levered as well. And so that is a more complex discussion. What they were doing was taking loans, and then they were basically hiding the fact that the default rate was higher into something else that was an instrument. I'm going to try to explain this simply, into something else, and then selling them the whole package. It's a little bit like when you buy a dozen eggs and you didn't look inside to see that one egg is broken. Well, in this case, they would put little chips in every single egg, such that by the time you put it in your car and your car's bumping, half of them are broken. That's what actually happened in 2008. That's not what's going on right now. What's going on right now? Yeah.
I think most of my audience has watched The Big Short, so they get what you're talking about, right? That was hidden, defaults in mortgage packages of mortgages, right? That's
Yeah.
not what's happening right now.
No.
Now we have a confidence crisis on top of a recession that is going to maybe snowball into bank runs. Someone's asking, why should we feel sorry for these banks if they get taken out? I don't know about you, May, but I'm not going to feel sorry for the banks. I'm going to feel sorry for everybody, businesses and individuals who get wiped out when the banks fail. I mean, you're
Yeah.
going to see just mass chaos.
Yeah.
But what are your
It's
thoughts?
boring. Yeah, I totally agree with you. This is not about the banks. This is about the insurance portion. I'm sorry. This is about the depositor, and also it's about the fact that if FDIC insurance starts getting run like this, if you think inflation is bad because rates are increasing, guess what inflation looks like once FDIC insurance goes to zero?
And then they got to print more money. Yeah, we're screwed. So
Yeah.
I've never really gotten behind this. I want all the banks, and there are literally people that want every bank to fail because they don't like them. But I think more pragmatically, like what the impact to this country is, and it is not going to be. There'll be a couple people probably that come out good, and the rest of everybody else is walking around in ashes.
That's correct. And it's not just even, and then if you're a foreign person watching our show right now, you think if you're like, oh, ha, 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 I've always hated the United States, guess what? Your country is if your country is even two steps behind us, I'd be shocked because most of the pension funds absolutely have exposure to the United States. Our financial system is so big, it is actually the only thing that you could possibly invest in the size that pension funds are. So a U.S. banking crisis isn't just a U.S. banking crisis. It will get exported so fast it's not even funny. If anything, if you're a foreign person wishing us ill, you're sick in the head. There's really no other way to say it.
It's a zero-sum game almost. I mean, unless you've been
Or even
stacking up.
worse.
Who's been stacking up gold, May?
No. I mean, commodities
What
traders
country?
always,
What country? I think you know.
I mean, some places in the Middle East. I don't know the answer. Tell me the answer. China?
Yeah, I think it's China.
Oh man.
China.
Yeah, the thing with China that's crazy is that they I know I hate that sometimes. I was like, so guys, don't be mean to Chinese Americans, okay? That's all I have to say. But it's not in their best interest necessarily for us to have like a true financial meltdown because it impacts a lot of things. The ways that they benefit, I'll just go ahead and say it so that you guys don't think that I'm biased. The ways they benefit is that if it's better to hold the renminbi, the yuan, whatever people call it these days, if it's safer to hold the Chinese dollar, then it improves Chinese stance as a reserve currency. And right now, this is in Ray Dalio's book. If for some of the nerdier people, Ray Dalio does have a book where he describes this pretty well. China has about a 2% market share on reserve currency. Europe and the euro usually clocks in around 25 to 30%. And we are closer to 55 to 60%. And then there's a host of other currencies other than that form the rest. The US reserve that's part of the reason why a contagion in the US will go overseas extremely fast. Because basically the actual bank itself, the Bank of England, all these other like actual banks are holding US dollar as much as they're holding gold or something else. So it doesn't, like us going under, if you're a foreign national that hates America, it may also mean you're going under too, but maybe that's the game that some people are playing. I don't know. You guys are so funny. Sergeant Beef, you're hysterical. There's no one. I live in New York, okay? You guys are hysterical. Blink twice. You guys, okay, this is just funny, you guys. All right. I'm a pacifist, all right?
I think he was talking to me.
Oh, sorry.
No, he was. There are video content creators, May, where they're talking, but they're always like looking over their shoulder, and we always joke that their handler is like got a gun to them. Don't say the wrong thing. Say the programmed message. Sell AMC. Adam Aaron sucks. Did I get it right?
That's funny. I sometimes will look up if I have to like word what I'm saying very carefully, like I just said. Then I'll be like, how do I want to say this exactly?
You have a much
You
prettier
do that,
backdrop
Gabby.
than some of those people. They look like they're at a prison backdrop too, just a blank wall and one little light bulb pointing at their face. Every now and then their handler lets them walk through the park though.
That's horrible. That's so funny. All right. So I mean, like there's a lot of questions here. Hopefully we were helpful on this. All right. Should we end it there?
Yeah,
Cool.
I think so. You shared a lot of knowledge. I appreciate you having me on and helping
I'm so glad you came on. I know it's
answer
so
people's
awesome.
questions.
All right. Good luck, guys.
I'll be
Bye.
around, guys. I'll probably do a live stream tonight and pop out a couple videos. I've got a couple companies that I'm working on that had recent earnings and a couple of other stuff. So I'll be around. Thank you, May.